In today's video, we are looking at retirement preparation questions. Before you retire, here are the 5 questions that you need to ask yourself and answer so that you can know that retirement is right for you. Coming up next. Hey, this is Tommy Neesmith. I'm a financial planner at Christy Capital Management, where we help federal employees prep and get ready for retirement. If you want more information on this, please subscribe. Today, we're going over the 5 questions that you need to ask yourself. The first question is, what does an ideal retirement lifestyle look like for you? Are you moving to a new state? Are you doing charitable work or are you going to travel? What are you doing with your lifestyle in retirement? Also, what type of lifestyle are you trying to live at? And I'm talking money-wise. How much money do you need monthly to live out that lifestyle? Typically, people think it's setting an amount that stays the same in retirement. But what we found is that in the early years of retirement, people tend to be more active. We call that the go-go years, traveling, doing things, and spending more money. Then they'll go through a time period where they don't spend as much money for a good number of years, and we call that the slow-go years. And then all of a sudden, medical expenses start to kick in, and you're not traveling as much, and we call that the no-go years. So your lifestyle expenses won't be linear. That's the key takeaway. There will be some ups and some downs through retirement. Another question you need to think about is which retirement accounts are you going to reach in first to take money from? For a lot of people we talk to, the traditional TSP or IRA is really the only funds they have. If that's the case, then this question is pretty easy. You're going to take it from your traditional assets. But hopefully, if you've been watching our videos, you realize you may need to have some diversification. You may want to have some TSP or IRA money. Most people do. It would also be nice to have some Roth money that would be tax-free to you. You know, ideally, you'd have some taxable money where you could get your hands on it with no age restrictions or limitations. We call that non-qualified money. It'd be great if you had some of that saved for emergency funds. When we're working with clients, they call up needing money. We'll go through kind of a checklist of each of the accounts that we're managing, and we look at which account makes sense to take the money from. If you take it from a non-qualified or a joint account, that's not retirement money. You may have to pay capital gain taxes on the growth. Whatever gains you have will be taxable. That's all depending on the market and what's been going on. You know, you may not have any gains at all to pay. That might be a great place to tap into if you need money. However, if you've had the account for a number of years, you probably have some gains in there and you may not want to take it from that account. Again, it really depends, but having someone to walk you through that brings great value to the people that we work with. If you take money from the traditional accounts, like traditional TSP or traditional IRAs, the entire distribution will be taxable. Now, that doesn't mean you don't take it from there. It just means it'll be taxable. If you have a Roth account and you've had it for at least 5 years and you're over age 59 and a half, you may take the money from that account and it could be tax-free. At first glance, you know, taking the money from the Roth account sounds great. Maybe that should be where you go get your money from. But wait, let's look at it a different way. You know, it took a lot of effort to get that money in the Roth account. If that money stays there and grows over time, it's tax-free money growing. From that point on, it sounds like you might not want to withdraw it from the Roth money, but you want to leave it and let it keep growing. Maybe the Roth money is the last money you ever touch. But every situation's different. Ideally, you'd have multiple options. Depending on your situation and what's going on in your life at the time, it may make one account the obvious winner of where you should take the money from. But it does take some planning. What we find a lot of times is that people really don't have a choice in which bucket or which account to pull from. They only have one account, and that's their traditional TSP or IRA. And if they do need the money, it's taxable. Well, another question you need to ask yourself is, when will you take Social Security? We generally talk about 3 choices, but in reality, there are endless options. The three choices we talk about oftentimes are, do we take it at age 62? Do we wait until full retirement age? Or do we take it at age 70? Now, 62 is the soonest you can turn it on. And for people born in 1960 or later, if you turn it on at age 62, you're only going to get about 70% of your full retirement age benefit. Now, in this conversation, full retirement age would be age 67, where you get 100% of the benefit that you're supposed to get. And in the last scenario, if you wait until age 70, you'll actually get 124% of what you should have gotten at your full retirement age. Now, we talk about these 3 as if they're the only options, but again, there are endless options available with Social Security. Every month that you delay, you'll get a little bit more money. So you can turn it on at age 63 in 3 months if you want to. Generally, the discussion moves over to how to maximize it. Where's the break-even point? So this is determined based upon how long you think you're going to live. Here's a recent JP Morgan study that they did that says if you turn it on at age 62 compared to full retirement age, 77 years old is your break-even point, which means if you're going to live longer than age 77, you would rather wait until age 67 for your full retirement age. If you're not going to live until age 77, it would be better for you to turn it on prior to that. Age 62 would be a better move in that situation. Now, the break-even point between turning it on at full retirement age is age 67 versus age 70 is 81. That's where the numbers crossed each other. So if you're going to live longer than 81, then wait to age 70. That would give you more money in the long run. Clear as mud, right? The problem with this is that we don't know how long you're going to live, but you may have some idea, and you can use this with your planning. Well, let's take that to the next level. If you turned it on early and you didn't spend it, but invested, could you do better than waiting to age 70? Well, a lot of that depends on what your expected rate of return is. In the same JP Morgan printout, this shows you a chart of when to turn it on. Let's say you're going to live to age 82 and you're only going to earn 1% on your money, then waiting to age 70 is better. But what if you're going to live to age 81 and you're going to earn 8% on your money? You can see here in this example that you probably should turn it on at age 62. So the more aggressive and the more expected rate of return you can get on the money makes sense for you to turn it on early if you're going to reinvest your Social Security. Now, the next question is, how are you going to pay for health care? You know, one of the great things about being a federal retiree is that you get to maintain your federal employee health benefit in retirement as long as you had FEHB for 5 years prior to retiring. The government pays 72% of your premiums and you pay 28% of the premiums. I assure you that private sector companies that other people work for do not pay for 72% of health insurance premiums in retirement. So y'all as federal retirees have a great thing going. In retirement, the federal government's gonna pay the same portion with one major difference. You're gonna be paying your premiums with after-tax dollars once you retire. As opposed to before, while you're working, you're paying with pre-tax dollars. But your federal health care will act the same way in retirement that it did while you were working. Same copay, same everything. And at age 65, Medicare then comes into play. We have specific videos talking about whether you should do FEHB with Medicare or do FEHB on its own. Feel free to check those out. But the fact that you have the federal health care means that this is not going to be as much of a worry as it would be for a non-federal retiree. So the last question is, how are you funding retirement? If you're a federal retiree, you're going to have a first pension. You'll have Social Security. If you're married, you'll have a spousal Social Security. You have your TSP or traditional IRA and Roth TSP IRA money if you did it. Maybe you move that money out into IRAs, so you'll have individual retirement accounts. Some people get annuities, and it's another option to diversify. Federal retirees and their pensions allow them to fund retirement in a better way than most non-federal people. You know, getting a financial blueprint done where we can show you the income you have coming in versus the expenses you have going out helps answer the question, do you have enough money? This can be vital for you understanding what retirement looks like financially. If you want help planning for retirement and you want to talk with someone that understands your federal benefits, go to ChristyCapital.com. If you're close to retirement and you're not sure if it's too late to start Roth TSP, check this video out right here. If you're like a lot of people that haven't even started Roth and you think it's too late for you, watch this video and you'll find out. I hope you're having a great day and happy planning.